I'm happy to report a new package of laws related to California insurance that took effect January 1 of 2026, aimed at strengthening property insurance across the state. The focus is on wildfire safety, consumer protections, and greater transparency, making insurance easier to use at a time when it's harder to get. For example, recently State Farm Insurance nearly doubled my rate, although I was able to find a suitable replacement, and they no longer issue new policies in the state at all. And as a real estate agent, for every offer I write for clients, I include an insurance contingency, which allows them to exit the contract without penalty if they're unable to obtain an adequate insurance policy. That is standard practice now, whereas before you just assumed the property would be insured. As climate change fuels more frequent and severe disasters, insurance will continue to get more expensive and less available in many parts of the state. These laws are an attempt to stabilize the system by increasing oversight, improving protections, and adding basic conveniences for Californians navigating a rapidly changing risk landscape. The laws briefly here are as follows. SB 495. After a total loss, insurers must now automatically pay 60% of contents coverage, up to $350,000. No exhausting inventory required. Homeowners who document everything can still claim 100%. SB 429, which creates the nation's first publicly owned wildfire catastrophe model, giving the state a transparent way to compare insured climate risk models when companies ask for rate increases. And we have AB 888, which establishes grants to help pay for fire hardening upgrades like fire-resistant roofs and defensible landscaping. Then there's AB1, which requires regulators to regularly update wildfire safety rules and pushes insurers to offer discounts for mitigation efforts. Then there's SB 547, which extends the one-year ban on insurance non-renewals after a fire to businesses, HOAs, condos, nonprofits, and affordable housing, not just single-family homeowners. The last two bills here have to do with the California F.A.I.R plan. F.A.I.R stands for Fair Access to Insurance Requirements, which is the state's insurer of last resort. AB 226 allows F.A.I.R plan to issue bonds if it faces insolvency, helping prevent a sudden collapse of the state's insurer of last resort. AB 234 adds legislative observers to the F.A.I.R plan board to improve transparency, even though they won't have voting power. And there's AB 290, which requires the F.A.I.R plan to offer automatic payments, reducing accidental policy lapses caused by missed or delayed bills. But headwinds remain for the insurance market. Here's the critical insight from Dave Jones, former California Insurance Commissioner and now Director of the Climate Risk Initiative at UC Berkeley. Quote, "Insurers are not going to be able to rate increase their way out of the climate crisis," end quote. Jones argues that climate-driven losses are growing faster than pricing models can keep up with. Even if regulators approve every rate hike insurers ask for, the math eventually breaks. This isn't theoretical. We've already seen this play out elsewhere. Florida is a warning to California. It has done everything insurers asked for. They allow climate models. They allow reinsurance costs added to rates. Reinsurance is insurance for insurance companies to help cover larger catastrophic losses. They limit lawsuits. They created taxpayer-backed reinsurance pools. They shield insurers from assessments when the state's insurer of last resort runs out of money. And the result? Home insurance premiums in Florida are 3 to 4 times the national average. Yet despite all that, major insurers, including farmers, have left the state entirely. But why? Because hurricanes, intensified by climate change, have made the risk fundamentally unprofitable. Jones calls Florida Exhibit A proof that deregulation alone can't outrun climate risk. As private insurers have pulled back, more Californians are pushed into the F.A.I.R plan. 35 states have a F.A.I.R plan, including California. It's important to understand what it is and what it isn't. The F.A.I.R plan is not a state agency, and it's not taxpayer funded. It's a legally required, involuntary association of private insurance companies created to insure properties that private insurers won't cover, particularly in wildfire-prone areas. The F.A.I.R plan is designed to pay all valid claims, but if losses are extreme, it can raise money by assessing the broader insurance market. Right now, California's F.A.I.R plan has about $200 million in reserves and $2.5 billion in reinsurance. The Los Angeles wildfires will almost certainly exceed those costs. If that happens, state law allows the F.A.I.R plan to charge private insurers across California based on their market share. And under a recent order from the California Insurance Commissioner, modeled after rules in Florida and Louisiana, those costs can ultimately flow through to policyholders. Insurers are responsible for the first $1 billion what the F.A.I.R plan can pay, but they're allowed to pass half of that cost on to their customers. If losses go beyond that, regulators can approve assessments on all policyholders statewide. So the bottom line is this. If FAIR Plan losses from the fires exceed its financial capacity, California could face special assessments on top of already rising insurance premiums, even if their homes were never damaged. And renters, they're not immune either. Renters' insurance rates were already rising and are expected to climb further after the LA fires. So the laws that went into effect this year are meaningful improvements, but it seems they help manage the symptoms, not the underlying disease. Jones leaves us with a stark warning, quote, "Insurance availability and pricing is the canary in the coal mine for the climate crisis, and the canary is about to expire." California isn't alone. At least 18 states are seeing similar insurance pullbacks tied to climate-driven disasters. The uncomfortable reality is this: we need to make progress in climate risk reduction coupled with insurance reform. We cannot move into a world where large parts of the country become effectively uninsurable. But for now, I'll take the win that these new laws represent. Thank you for joining me on this week's episode of Creative Real Estate Ownership. My name is Josh Silverman. Please email me here, and I'd be happy to connect you with an insurance broker that I like and trust. Thank you. Be well.